cash flow. I'm sure that you have learned this topic in the previous semesters, so this is just a refresh of what you have learned before. So basically, you know that when you prepare cash flow, there are two methods, either a direct method or indirect method. And every annual report of a company, they should provide or they should prepare a complete financial statement, which is SOPL, SOCHI, SOFP, notes to the account, as well as the cash flow statement. Alright, so the function of these financial statement are different. For example, if SOPL, it shows how much the profit of the company are making for that year. SOFP is showing the financial position in terms of asset and liabilities of the company, and for cash flow, it shows how much cash access at the end of the year, because sometimes company that has a lot of profit, not necessarily that they also have extra cash, because the preparation of the SOPL and the cash flow are different. SOPL is where you include all the accruals and prepayment, as well as deduction of non-cash items such as depreciation, gain and loss, alright, gain on disposal, gain on fair value, loss on disposal, loss on fair value. So those are non-cash items where you don't pay for it. So just by looking at the profit or loss of the company, you don't see the availability of the cash, right? So that's why sometimes when company is making a lot of profit, not necessarily that the company also have an extra cash. Okay, that is a different item, different component in which how efficient that the company is managing its cash. Okay, so this is why every company need to prepare a cash flow statement, and these cash flow are divided into three categories. There is operating activities, investing activities, and financing activities, and each of these components actually relate to the SOFP, in which all operating activities that involve with the trading or the nature of the business itself. Investing is investment of the company relating to the non-current asset and the current asset of the company, and financing activities relates to the component of the equity, non-current liability, and the current liability of the company. Okay, so these are some of the definition. I'm sure that you are well versed with it. What is cash? Cash is basically the money in hand or the money that you have in the bank. Cash equivalent is anything that is converted into cash, right? It must be in short term and has highly liquid. That is, anytime that you need cash, then you can easily sell or convert it into cash. All right. Operating activities are any activities that involve with the principal trading activities of the company. Investing are the acquisition and disposal of long-term assets, and financing activities are activities that result in changes in the size of the composition. So this is what I've mentioned just now. Investing is any activities that relates to your non-current asset and current asset. Financing activities are all those activities that related to the equity, non-current liability, and the current liability. So you may refer to your SOFP, alright, to identify whether it is an investing or financing. If those component is not relates to the investing and financing, then it should goes under operating. Okay, so these are the advantages of cash flow statement that you may not find it from reading the SOPL or SOFP. That is to assess the liquidity status of the company. That is, when you know the balance of cash balance of the company, then you might say that the company has the ability to pay back its obligation. Alright. Sometimes, okay, when we say that, okay, dividend is paid out of profit, okay, the company is making a lot of profit. So supposedly the company should pay dividend, but sometimes when the company do not have cash to pay dividend, that's why the company choose to replace that cash dividend into shares, right? Instead of buying cash dividend, because the company do not have enough cash, so the company is paying dividend in terms of shares. All right. And then assist in planning, budgeting, and controlling. All right. So the financial planning analysis is done with the help of cash flow statement. It helps the top management to coordinate financial operation. So from here you will see that since cash flow are divided into three categories: operating, investing, and financing. From here, the management can assess the how well the company is managing the activities in terms of investing, financing, and operating. Whether the company is utilizing more cash to certain to a particular categories, all right, which compromise the other activities, all right. And then for example, when you prepare the cash flow, you see that the investing activities consume more cash, so the investing activity has a deficit cash flow. So what we can say generally, that the company is spending too much on buying asset, for example. So does this asset allow the company, or enable the company to make more profit in the future? So this is what the company need to look at. All right, because when you buy asset, yes, you might claim that this asset will be used to generate more product. So do you really need this asset? Do you really need this investment? Because when you buy the asset, you need to depreciate the asset, so that will actually increase your expenses and reduce your profit. And in fact, if you don't optimize the use of the asset, you don't actually match those investment with the revenue that you are going to generate. Okay, all right. Performance appraisal. The management can evaluate the performance regarding the cash by comparing actual cash statement with the projected cash flow statement. Okay, comparing the budgeting cash flow and the actual cash flow. So this is where you can see whether you are spending more than what you have planned. Okay, and this also relate to the financial management. How do you manage, for example, when you apply for liability, you have option either current liability or long-term liability, because long-term liability will make you pay more interest. So is that necessary? So this is what you have to balance, and you have to match within between your investment and the liability that you make, right? And those planning and investment decision will actually affect the cash flow, right? The balance of your cash flow. All right. And then in terms of movement of cash, all right, it of course it represents the how much the money goes into the company and goes out from the company, all right, in order to fulfill the commitment under each three categories under the cash flow statement. Okay, so this is the limitation of a cash flow statement. So when you want to assess the performance of the company, you don't only look at the SOPL, SOAP, or the cash flow statement alone. You have to look at all the this set of financial statement together. Okay, in which cash flow will not able to show you the net profit, of course. Okay, it is not a substitute to income statement. Okay, because what you pay now, okay, it's not necessarily the expenses that actually incurred, because cash flow statement does not include the accruals and prepayment. For example, that you get an invoice, the amount is 5,000, but you don't have enough money, so you just pay 2,000. You are still owing 3,000, so only 2,000 is reflected in the cash flow. So it does not tell the whole story about the company, all right, because you just paid that 2,000. But for profit and loss, they show you the total expenses that incurred in that year, which is including the accrued and prepayment. So you will see that from the SOPL, you can see how much is the actual expenses and revenue that is earned or incurred for that year, which this is not shown in the cash flow statement. Cash flow is just the actual money received and the actual money paid from the company. Okay, industry comparison is also not possible because it's depend. If your company is paying more, then your cash outflow will be more as compared to other company. Okay, and then probably the investment that is made by other company, of course, is different from our company. So it's very difficult to assess, compare our business with the other business just by looking at the cash flow statement. That will, using the SOP and SOP is more better. Okay, so this is basically the operating activity, which is the activity that relates to the nature of your business. All right, this is okay, this is the detail where cash inflow from the operating would be the money that you receive from the sales of whatever product that you sell or service that you provide. And then probably you also have a receipt from royalty, commission, and other revenues. And the cash outflow would be the payment that you made to your supplier or income tax, and anything that relates to the operating activity. For example, when you prepare under the direct method, you have to show how much is the money received from your customer and how much that you pay to your supplier. So those are relates to the activities that you are running. Okay, this is the direct and indirect method. Direct method, of course, is very straightforward, where you need to show how much is the cash received from customer, payment to supplier, and for other expenses. And for the indirect method, where you will start your computation with the profit before tax. Alright, and you have to adjust for any non-cash item and the non-operating activities, because these item, non-NCI and the non-operating activity, are those included in the net profit but shouldn't be appearing in the cash flow. Alright, so okay, I will explain this later in the next video.